Severe policy strain has forced the market into a late-cycle apex, splitting the tape into two divergent lines. Price action currently avoids both the Goldilocks disinflation tailwind and the restrictive breakdown. Instead, we see immense macroeconomic friction. Oil and broad energy costs remain elevated, exerting constant upward pressure on nominal pricing, while long-term rates stay pinned near 4.72%. This friction fractures the market. On the left, right-translated leadership, resilient assets in rates, commodities, and crypto. On the right, left-translated weakness, the dollar complex and mega-cap equities struggling to recover. These leadership assets absorb elevated rates, outrunning macroeconomic friction. Broad index momentum has become an unreliable metric. Survival in this polarized environment requires a selective, structural framework to measure actual asset durability. Traditional business valuation frameworks often fail to explain why expensive assets keep accelerating, while perceived bargains collapse in a highly sponsored market. Navigating this environment requires a different lens, a structural framework that evaluates market health through pure geometry and time cycles. This framework relies on three core pillars: Kaufman's adaptive moving average, or KEMA regimes, which track the structural trend, the cycle translation, which identifies bullish or bearish bias, and a quantitative scale measuring upside exhaustion. We then evaluate sequence risk by tracking exact harmonic squaring. This occurs when an asset's elapsed time and its price rotation align on the same degree of a 360-degree grid. Applying this geometric grid to live tickers allows us to objectively separate healthy institutional accumulation from mathematically forced exhaustion. We begin with the strongest geometric profiles in the current macro grid to validate their underlying momentum. The 10-year yield, ticker TNX, exhibits one of the strongest geometric profiles in the set, defined by a dense and unbroken structural trend. Specifically, the data shows a 908-bar bullish comma regime paired with a right-translated, bullish-biased cycle that is currently approaching its apex. The bearish counterargument notes that the yield is dangerously late in its cycle and is pressing immediate resistance near 4.76. However, the upside exhaustion metric shows only moderate upside heat, indicating a mature optimistic zone rather than a blow-off top. Bitcoin exhibits similar structural dominance, coiling below 65,800 resistance. Its exhaustion reading remains unusually light, with an adaptive RSI of 45.95 and an exhaustion count of 1. This low exhaustion and accelerating trend slope suggests a strong runway for late-cycle expansion. While central bank holds and tightening represent a macro headwind, Bitcoin's geometric trend is currently outperforming those liquidity constraints. For these strong bulls, the underlying geometric trend state is significantly stronger than the perceived momentum objections, favoring continuation over failure. Mapping the time factor is the necessary second step for any strong trend identification to predict cyclical apexes and sequence risk. We calculate squaring when an asset's elapsed time and price rotation hit the exact same harmonic degree, creating intense reversal pressure. We can visualize this using Bitcoin's trough anchor from September 2024. The vector sweeps clockwise to plot a price rotation of exactly 270.31 degrees. This places the rotation just 0.31 degrees away from a perfect geometric alignment on the 270-degree harmonic. However, the second vector, representing 711 days of elapsed time, does not align with that harmonic. Because the time and price rotation do not square, the asset faces partial geometric vulnerability rather than a mathematically forced reversal. Mathematical time-price squaring is the ultimate arbiter of market turning points, acting as a ceiling that pure momentum cannot break. We now pivot to the darker side of the split tape, focusing on assets flashing immediate sequence risk and structural exhaustion. The Russell 2000 appears strong as a highly sponsored index, but its trajectory hides a significant danger. This index is currently operating in a post-peak cycle phase, a direct contradiction of its upward price trajectory. Small caps are among the most liquidity-sensitive assets, making them highly exposed to the conflict between sticky yields and tighter financing conditions. The Russell's critical warning metric is its upside exhaustion scale, which is pegged at an extreme -8, the most overextended reading in the current market run. Inflation compensation instruments like RINF showcase a different structural danger, the flat slope terminal top. This chart shows an absolute absence of slope acceleration as price presses toward its upper boundary, levitating an asset into stiff resistance just days before a major time node. In this case, the August 2026 even square is a classic signature of market manipulation. We categorize this architecture as a distribution euphoric trap, designed to draw in late-stage retail liquidity before an institutional reversal. When maximum upside exhaustion meets immediate time node resistance, the math demands defensive positioning, regardless of the headline narrative. The macro environment remains modestly expansive and bullish, though it is plagued by targeted friction from inflation and elevated rates. In this selectively sponsored market, risk management relies entirely on tracking upcoming time nodes to dictate entry and exit protocols. We utilize asymmetrical protocols to separate data from noise, dividing assets into two tactical groups. For the constructive trend-following group, the protocol scales with confirmation, buying pullbacks at structural support. For exhausted assets, we shift to tighter risk control, avoiding oversized spot chasing into resistance. A shakeout setup near a node is often a high-probability buying opportunity, while a euphoric trap at resistance is a terminal warning. In this apex-style environment, the market has effectively ceased rewarding blind momentum. While the system remains operational, every subsequent leg higher is now dependent on policy credibility and liquidity tolerance. The burden of proof has officially shifted. Success in a split tape belongs exclusively to those who trade the geometric nodes and scale only with structural durability.